मरघट तक है तेरी कहानी, पग पग प्यारे। दंगल 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 दंगल, सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे। दंगल 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 दंगल।
Great morning, my dear friend Bhupeshanand again. Lecture number 5 we are starting with. In this lecture number 5, equity valuation, basic concepts and tools. In this reading, I want to tell you the practical aspect that how we can calculate free cash flow for equity, how we can calculate free cash flow for equity or for firm. In the last lecture, I have told you the 4 approaches for calculating free cash flow for firm. But we will be doing the practical part today. No doubt that is covered in CFA level number 2. But still, in case you will be doing these 2 or 3 examples along with me, the basic concept of FCFF and FCFE will be more clear to you. So please, today's lecture is make it as a star lecture. And please take out your calculators. Calculators are very important. Today we will be doing calculations with the help of FCFF, and we will be understanding what is the practical emphasis of these cash flows. So let's start with the journey. Please take out the registers. Lecture number 5. Great morning, great morning, great man morning. Practice makes the man and woman both perfect. So let's do the practice. Equity valuation concepts and basic tools. We are on learning outcome B only, that what are the different types of valuation methods. I have not covered any other learning outcome because this is the most important learning outcome which we are doing. So let's start the journey. Come on. The first point is that free cash flow from firm can be calculated with the help of 4 models, with the help of four approaches, with the help of 4 formulas. I have told you, and I have prepared a summary for that, a table for that. The first is NI approach. When I did NI, that is profit after tax, plus NCC, non-cash charges, plus minus working capital investment, plus after tax interest, plus minus fixed capital investment, and the balancing figure we calculated FCFF. Now the point is, when we do profit after tax NI plus NCC plus minus change in working capital, up to this point we have calculated CFO. So if I am given with CFO, I can derive my second formula. CFO plus interest after tax and plus minus change in fixed capital investment. That will also be fixed FCFF, free cash flow to firm. And then the approach number 3 we did. How we have calculated EBIT. If I am given with EBIT, I will be calculating NOPAT. EBIT into 1 minus tax. Then I have taken the effect of non-cash charges. Then plus minus working capital investment. I will not be taking the effect of interest because earlier I have taken EBIT. Then plus minus fixed income in fixed capital investment, and the balancing figure will be FCFF. And the last model is ABITDA. We will be taking earning before interest, tax, depreciation and amortization after tax. So plus tax saving on depreciation. I will not be taking any effect of interest because I have taken plus this. So plus minus working capital investment, plus minus fixed capital investment, and the balancing figure is FCFF. This I have already told you. So in today's lecture, I will be firstly doing 1 or 2 practical questions on FCFF, and then I will be telling you what is the meaning of FCFE, how we can calculate FCFE. Because when I say free cash flow for equity, it means I am only watching for equity. It means I am not for debt. But when I say free cash flow for firm, it means for debt as well as for equity both. So please write your first point, take out your registers. This is just revision that free FCFF can be calculated by the 4 approaches like this. And practical examples of understanding this. Now let us start the practical example. No doubt that will be in CFA level number 2. But my dear friends, this is my humble request. Please note down this whole examples. Your concepts will be more clear. So let me start with example number 1. I have taken a conventional balance sheet. not as per IFRS. I have just prepared a traditional balance sheet that let it be equity and debt liability side, let it be asset side, and I have taken the example of a company, and the main business of this company is leasing the assets. It means this company is getting rental income from the assets being leased. So firstly, they have borrowed, they have taken the money from equity 50 million, from debt 100 million, and the total assets are 150 million. And these assets are being given on lease and rental income is being realized. You getting my point? So please write down example number 1. Following is conventional balance sheet of a company XYZ, and the liability side equity and debt. In the asset side assets 150, and I am assuming that XYZ is in a leasing business. XYZ is in a leasing business, and following is the information, because when I lease the assets, I will be getting rent from that. So let the rent be 70, 70, 70, 70, 70 million, 70 million, 70 million. It means I am given with free cash flow. It means I am given with net income. I am given with net income. Only this is the information which is given to me. So other information, just write down other information. For calculation sake, because I am doing the first question, the cost of equity I have assumed as 20%, but cost of debt also as 20%. But I may tell you that cost of equity is always more than cost of debt. But for calculation purpose, assumption purpose, I have assumed at this, and tax rate I have taken at 0%. Tax rate as 0%. So on the basis of this information, I will be calculating the value of the firm. Now the point is, I am neither given with net income, I am not, nor given with tax rate, nor given with depreciation, no working capital investment, no fixed capital investment, nothing going off. This interest also I am not aware that how much is the interest which I have to pay. Because tax rate is zero, tax rate is zero. When tax rate is zero, then it has no relevance. So first step is I will be preparing timeline, and on the basis of that timeline, I will be writing what I will be writing the future cash flows. So please note down this point number 1. Now when calculating FCFF, we are concerned in calculating total cash flows generated by assets. Total cash flows generated by assets, that is cash flow available for equity as well as for debt. So first point is I will be writing down the cash flows, future cash flows which I will be getting, and because only the rental income is given to me and the question is silent, so I am taking this $70 million as free cash flow for equity. Nothing else is given to me. So I have prepared a timeline 70, 70, 70, 70, 70, and let the life be 5 years. Now I have to just find out the present value of these future cash flows with the help of a calculator, as we have done in dividend discount model, and then we will total it, and after totaling it we can calculate this value. So please take out your register calculators. I will be doing it along with you in this calculator, and I will be using TVM raw, second clear TVM, 70 is PMT payment, and 5 as N, and 20 as IY. Compute present value, that is coming to be 209.34. So what I did, I only calculated the present value of future cash inflows. Now those future cash inflows can be calculated by dividend discount model, or they can be calculated as per free cash flow for the firm, or they can be calculated for free cash flow for equity. In this example, I have used those inflows as per free cash flow for equity. So and I have discounted it, calculated the present value, and that is coming to be $209.34 million. So value of firm, we are all aware of debt plus equity. If I subtract debt, because value of debt is generally equal to book value of debt, and book value of debt is 100 million. So if I subtract 209.34 and 100 from 209.34, the balancing figure will be $109.34 million. This is the value of equity. You getting my point? Now, because I want to clear your concept, so I want to tell you that if we calculate value of equity as per FCFE approach, that is free cash flow for equity approach, then also I will be getting the same value of equity equity, that is $109.34 million. So I want to prove that. No doubt it is for CFA level number 2, but still, because if you are aware of these concepts, you can easily remember it, you can easily memorize it, you can easily link it. So I have just calculated one. I have calculated with help of example. In this tax rate is 0. Cost of equity is no doubt is more, but for calculation sake, I have taken as calculation sake tax cost of equity is 20% and debt is 20%. So weighted cost is 20%, because in case of free cash flow for equity, we discount it on the basis of weighted cost. So KW, weighted WACC, the weighted average cost of capital, because when equity is 20%, when equity is 20%, debt is 20%. So I will say average cost is 20%. So after doing it, I want to tell you how we can calculate again with the help of free cash flow for equity. So before coming to free cash flow for equity, just see the difference. This is free cash flow for firm. Now, if I want to calculate for equity, I have to deduct 2 items. I have to subtract 2 items. And if I subtract these 2 items, the balancing figure which is there will be named as free cash flow for equity. Now, what 2 items? It means those payments which we have to pay to the debenture holders, to the borrowers. We have to pay 2 things. One is interest, and second is we have to pay principal. Now, because interest is a revenue expense, it can be debited in profit and loss account. So I will be taking after tax interest, and principal amount is a capital amount minus principal. So please write down this formula: FCFE, 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 FCFE is equal to FCFF. FCFF, that is free cash flow for firm, which can be calculated by 4 models. Minus, because I want to calculate for equity. So before calculating for equity, I have to pay for debt, and I pay 2 items to debt to the borrowers. One is interest, and second is the amount of borrowing, the amount of principal. Because interest is a deductible expense, I take after tax, and then I take plus minus net borrowings. It means if I am paying borrowings, if I am paying principal amount, then I will deduct it. Supposing I am raising it, then I will add it. So I want to calculate free cash flow for equity. Please write down the example, please write down the formula. I will be using the same example, and I will be telling you how we can calculate free cash flow for equity with the help of this. Again, the value of equity will be calculated. So let's start the journey. In the above case study, it means in that case study in which I have assumed cost of equity, in this case study, I have assumed, that this is the balance sheet, this is the equity, this is a debt, this is the amount of assets, and this company is in the leasing business and is getting rent of this much, and cost of equity is 20%, cost of debt is 20%, and tax rate is 0%. So these are the informations which are there. But in this example, I will be calculating value of firm as per FCFE approach, free cash flow for equity approach. So let's see the journey. Let's see. Now I will be doing it with the help of calculator. Now because I want to find out that how much is to be repaid here. Net borrowings. How much is the net borrowings? I am repaying it. Supposedly I am repaying it 100 million as the amount, because I have borrowed 100 million. Because I have borrowed 100 million. So if I repay, if I want to repay this 100 million, then I am assuming that I am repaying 100 million, but it should be repaid in 5 years. Then how much is the amount per year I am repaying it? I have to see. Firstly, I have to calculate this borrowings, because I have to calculate free cash flow for equity for each year. So at least I should be aware of how much is the interest which I am paying each year, how much is the principal amount I am paying each year. So for that, I will be firstly calculating equal annual installment. My dear friends, I will be calculating equal annual installments. And that can again be calculated with the help of this PMTP. I can calculate the payment. How much is the payment which I am doing? Because I have to repay 100, and I have to repay interest as 20%, and this is the tax rate. So I have calculated for you that how much is the amount of borrowings. Assumption is I have repaid. I have to repay 100 million equal in 5 years. So how to repay it? Step number one, we have to calculate the amount of interest paid and the amount of principal borrowings to be repaid annually. This is my step number one, because I want to deduct these two figures, because I want to deduct these two items here and here. So first point is I should know how to calculate this, that how to calculate interest into 1 minus tax and net borrowings. Now for this I am using the calculator because I want to calculate interest and principal. So just see the calculator and please take out your calculator. Second clear TVM. So I'm going to start with present value. You know, present value is 100, because present value is 100. I have to repay 100. I have taken 100. So this is 100. 20 as 20 as IY and 5 as N and 5 as N, and then I have to compute monthly payment. That is going to be $33.43 million. It means if I am paying 100 million along with interest, then I have to pay each year $33.43 million. Now it is composite of principal and interest. Now I have to take only after tax interest, but because tax rate is 0, so after tax interest and before tax interest will be same, because I have already assumed tax rate as 0, because this relates to CFA level number 2, because it will again have different calculations. So just for understanding purpose, I want to just tell you how we can calculate the same value of equity with the help of FCFE approach. So I have taken tax rate as 0. So when I say tax rate as 0, it means before tax interest and after tax interest are same. So the point is, I have calculated the payments which I have to make in these 5 years. These are the payments. Now this is composite of interest and principal. So I have to firstly bifurcate how much is the interest and how much is the principal. Because interest I have to take it 1 minus tax, but I will not be doing in this question because tax rate is 0. So it is very simple now. Now I have written the same, that why I am not taking after tax interest, because tax rate is 0. So just see the calculation. So no need to calculate I into 1 minus tax. So I have written free cash flow for firm 70 less the two payments. One is interest, after tax interest, and second is principal. That I have already calculated as payment as 33.43. So I am deducting that 33.43. So the balance amount which I will be getting is named as free cash flow for equity. That is 36.57, 36.57, 36.57, 36.57, and then I can easily calculate with the help of a calculator. And cost of equity, I will be discounting it with the help of cost of equity. In free cash flow for a firm, we discount on the basis of weighted cost. But in case of free cash flow for equity, we discount on the basis of equity cost. So that is coming as 109.36. Same as we did as per FCFF. As per FCFF. So the last example, the last question, which I want to tell you, that how we can, with the help of forecasted figures also, forecasted cash flows also, we can calculate the value of equity with the help of FCFF and FCFE. So please, my humble request to you will be, please write this example. No doubt it is relevant for CFA level number 2, but once you do this, I will be assuring you, your concepts will be more clear and there is nothing to cram in that case. All 4 approaches, 4 formulas of FCFF you can easily remember with the help of logics. So let's start the journey. I want to again tell you a case study in which I will be telling you the difference between the way of calculating value of equity as per FCFF and as per FCFE. So on the basis of following information, calculate value of equity I have to calculate value of equity. So I will be doing it with the help of FCFF as well as with the help of FCFE. Please write down the question. First information is FCFF of a firm. We are given with free cash flow for firm. Already we are given it for 5 years. For 5 years, that is future cash flows for firm available for 5 years. Yes, we can, with the help of business models, with the help of our forecasted modeling, with the help of financial modeling, we can calculate the future values of the cash flows. So future cash flow will grow at a constant growth rate of GDP. I have assumed that there is a perpetuity growth rate of 6%. From fifth year there will be a perpetuity growth rate at a constant growth rate of 6% from 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 sixth year. So this assumption I have done. So this is weighted cost. So first is I have to draw a timeline, and then I will be writing the free cash flow for firm for these years. Now the point is, once I am aware with perpetuity growth rate as we did in dividend discount model, that the year in which it is perpetuity growth rate, from that year with the help of Myron Gordon model we can calculate the value of all the future years with the help of V0 is equal to D1 upon KE minus G. But here we will be doing V0 is equal to FCFF1 upon K minus G. But because growth rate is constant from sixth year, so I will be using the formula as V5 is equal to FCFF6 upon KE minus G. So I have written it. So please take out your calculators, write down this. Firstly, we'll be preparing timeline. I will be preparing timeline. Now let's see the timeline, that how much cash I am getting. This is given to you. All this is given to you, that 100, 120, 130, but in this sixth year onwards up to infinity, the growth rate is constant, that is 6%. So from this year, we can use the Gordon model formula, and then we can calculate the value V5 is equal to FCFF6 upon KE minus G. And then we can add this, and on the basis of dividend discount model, we can calculate the value here because I want to calculate the value of here. So on the basis of this, we can calculate, so let the value of firm be $895 million. Value of equity is value of firm minus value of debt. So I have calculated value of equity as 595. Now how to do it with the help of a calculator? Even I have written the steps. Please take out your calculators. Please take out your calculators. We will be using cash flow function. So cash flow second, clear work, cash flow 0, enter cash flow 1. Cash flow 1 is 100, enter. Then cash flow frequency is 1, enter. 120, enter. Frequency 1, 130, enter. Frequency 1, 140, enter. Frequency 1, and then one in cash flow fifth year, fifth year I will be using 1457. Now you must be worrying that how I have calculated 1287. I will be telling you. Just for a second, assume that you are aware that how we have calculated V5. So total value is 1457. Enter cash flow, compute NPV, and interest is 20. Enter downward NPV, that is coming as 895 millions. So 895 minus 300, that comes to 595 million. So my dear friends, in today's lecture I have told you that how we can calculate with value of firm with the help of FCFF and FCFE. So what is the method of calculating that 1287? I have written note for that. As per Gordon model, we can use this formula from the year in which growth rate becomes constant perpetually. Because from the sixth year growth rate is constant, so I have used FCFF 6 upon K minus G, and the balancing figure will be V5. And when it is V5, I have used the formula and I have calculated FCFF for sixth year, and then K minus G, and the balancing figure will be $1287 million. Hope you have enjoyed this lecture. My dear friends, today is lecture number 5 and we are in learning outcome number B only. Because in this total reading, the most important part is what are the different valuation methods which we will be doing. So in the next lecture number 6, I will be concluding with dividend discount model, because because discounted cash flow method, because there are 2 or 3 concepts which we have to discuss in this in this discounted cash flow, and then this model will be over. Once this method is over, I am assuring you within 1 or 2 lectures the whole reading will be completed. So be happy, be jolly, be cheerful, be happy,